All right. Um, I'd like to take this opportunity and to discuss risk and a return. Okay. Um, so there's a lot of number crunching in this lecture. So let me provide you with a little roadmap. All right. So we're talking about the two sides of the same coin. So if you're looking at any investments, you should really focus on risk and a return at the same time. So during the job interview, if people are asking about your opinions about, for instance, the return on any investments, and if you don't know what to say, well, you can always actually talk about the risk. Okay, so these are always coming and coming together. All right, you cannot ignore risk when talking about the return and vice versa. So let's just look at the different measures for risk and the return. Okay, so on the risk side, we have the finance field actually has a lot of measures for risk. For example, there is something called a beta. If you still remember, in our equity valuation discussion, we actually estimated a beta using regression in Excel. Okay, specifically, we estimate Walgreen beta using the past 5-year monthly returns on Walgreen and regress that return on the monthly returns of S&P 500. Okay, so beta is a measure for systematic risk. All right, and then you can also talk about the variance and the standard deviation. All right, so these are measures for total risk. So we know from the portfolio diversification principle that you can diversify away a lot of idiosyncratic risk when actually investing in the portfolio manner, because in your portfolio, some stocks are going to go up, other stocks are going to go down. So, they will cancel against each other. And so you are left with the kind of risk that cannot be diversified away, and that's labeled as systematic risk. Okay? The kind of risk that can be diversified away is the firm specific risk or idiosyncratic risk. All right. So, you can actually talk about, different measures of risk here. Looking at the return side, you can actually have, for instance, holding period return. Okay. So, you might be a short-term investor. Your holding period could be a month. All right. You buy the stock at the beginning of the month and you sell it at the end of the month. Okay. Your holding period could be, let's say, a couple of years if you actually invest in hedge funds. All right. So hedge funds, they actually require capital commitment. All right. You cannot, cash out or redeem your investment within, let's say, a number of years. All right. When you invest in bonds, the bond may mature in, let's say, 20 years, but you want to actually sell the bond at the end of year 5, because, for instance, you're trying to meet some cash flow obligations. All right. For example, you have to pay the pension to your employees and so on and so forth. All right. So holding period return is one thing you can always calculate. There are different ways for you to calculate holding period returns. For example, for bonds versus for equities. Um, and then you can also look at, for example, at historical returns. Historical returns. Okay, so these are the returns that are realized already, and if you have the data, you can just go ahead and calculate. All right, and sometimes you have too many historical returns, so you might want to actually calculate some kind of average returns. So there are many different kinds of averages, like for example, arithmetic average or simple average. Arithmetic or simple average. And then in your finance 310, you should also discuss the geometric average and so on and so forth. All right. And you can also look at expected return. So you're looking at the future instead of at the past. So you form your expectation, and you form, you expect the returns, on, for instance, Tesla to be, I don't know, if you talk to Kathy Wood, she might be telling you Tesla is going to eventually arrive at, I don't know, a few $1,000s a share. All right. So right now Tesla is trading at, around 600 or 700. Okay. So, this is the returns, risk side. This is the return side, and you wonder, is there any measure that actually, incorporates, information, into one simple, information about risk and return into one simple measure? And yes, we have something called, for instance, Sharpe ratio. Okay. So these are different measures, and the more or less we have touched upon them in Finance 201 or 310. All right. So here we're going to do, risk and return for individual stocks. Okay. And then we're going to actually do risk and return for, portfolio, for stock portfolios. Okay. So, as you can see, when we actually look at stock portfolios, you want to look at, for instance, what's the expected return on a stock portfolio? What's the variance of the expected return on the stock portfolio, and so on and so forth. And here I want to actually give you some, preview. So we're going to use the, variance covariance matrix, okay, to calculate portfolio variance. All right. / standard deviation. Okay, so we know the standard deviation is nothing but the square root of the variance. Okay, so this is the map, and as I said, we're going to be buried in a lot of calculations. So it makes sense for us to actually look at a little GPS and situate ourselves. All right. So I'm going to actually look, start with the first example here, and this is actually straight from, chapter 8 and 9 Excel spreadsheet. All right, so we're just going to actually develop maybe some Excel functions or some skills, about, risk and return for individual stocks as well as for portfolios. Okay, all right, so let's just look at the input here. So we have actually we have downloaded the daily stock prices, for, McDonald's, all right, from December 31st of 1998 to December 31st of 2008. So this is approximately, 10 years, all right. And we actually have, downloaded this data, let's say, from Yahoo Finance, all right. So these are the closing prices on McDonald's on all these different days. Okay, and so can we calculate the returns? So I'm just going to get rid of a few, returns. And if I want to calculate, the daily return, so if you're thinking of a day as your holding period, what you can do to calculate your holding period return is to look at the end of the day price, all right, minus beginning of the day price. Now, beginning of the day price for January the 4th, we don't have that. So we can actually use the previous trading day's closing price, as the beginning price for January the 4th. Okay, so this is the, end of the period price minus the beginning of the period price. And strictly speaking, you should actually add any dividends, McDonald's may pay over the course of this day. All right, so remember, these are the prices from Yahoo Finance, so they are adjusted for stock splits and stock dividends, so we don't have to worry about that. All right, so I'm just going to divide this by the beginning of the period price. So if that's the case, I calculate the daily return for McDonald's for January the 4th, and that's 0.19% or 19 basis points. Okay. And I can actually copy this down here, and I calculate the returns for McDonald's over the other days in our sample period. And this sample is actually pretty long. If you scroll down here, because we have about 10 years of return prices data, and every year we have approximately 252 trading days. Okay. because every year you have about 365 days, and you have the weekends and you have holidays. So you knock off those, you have about 252 trading days. So 10 times 252, that's about 2,520. Okay, so in this case, we actually have something around that. All right. So that is the holding period return, and now let's actually get a little analysis about this daily return for McDonald's. Notice that we actually lost the one observation where we go from prices to returns. So we cannot calculate the return for December the 31st of 1998 because we don't have the the closing price from the previous trading day. Okay. All right. So now I can actually look at, hey, what is the number of days I'm looking at? So I mean, you can count how many rows you have because each row corresponds to one trading day. All right. One day. All right. So I can actually do a count function here. So the count function is apparently going to count. All right. So what's the data range you want to count? Well, I want to count number of days. So I'm going to go from A3. All right. So that's the first one. I start counting here. And the last one is actually, A2518. Okay. So A2518. I'm using the colon sign to pick up the numbers in between. So that is, 2516. And that's actually the number of days. And if you look at number of returns, that actually is one less. Okay. All right. So that is number of days. And I want to look at over the course of this 10-year period, what is the worst return on McDonald's? So if I want to actually pick up the worst return, I can do a mean function here. All right. So I'm going to let Excel look up the smallest number of all the returns we have. All right, so that's C4. All right, that's the first number, and I want Excel to look up all the numbers through C2518. All right, so that is 12.82% negative. So this is really, very bad returns. All right, you're talking about a day you're losing 13% approximately. You start the day with $100. When the day ends, you actually have about $87 left. All right. So I hope you do not have this kind of investments in your career. All right. The maximum return, well, that's actually using the max function here. So I'm going to look at the same data range. That's C4, C2518. Okay, so that will be the maximum return over this time period. That's about 10%. That's great returns. Okay, all right. So I want to look at when the worst return happened. All right, so I know there's a worst return of negative 12.82, and I want to look at when this happened. So imagine you can actually scroll down this manually and look up when that happened. All right, but I'm going to actually, use two Excel functions to do that. Okay, so first of all, I'm going to use a match function here because I want to essentially, I want Excel to actually look up a number in column C that actually matches the worst return we have just looked up. Okay, so I'm going to do a match function here. All right, Excel says, what is the value you want to look up? All right, I'm going to look up this worst return here. Excel also says, where do you want me to look up this worst return? Well, I want Excel to look up the worst return in C4 column C2518. And Excel says, how do you want me to match that? Do you want to do a less than or exact or greater than? Well, I want Excel to do an exact match. So if you do that, Excel spits out 931. Now, what does that mean? This is telling you if you're looking at the data, data range, C4 through C2518, that negative 12.82%, that is the 931st number in this, data array. You know, array is actually our Excel, you know, matrix. Okay, so you know, this is the 931st number. Now, how do I get the date? Well, I know that, you know, if I look, you know, across this, if I look to the left, if I look at a column B, all right, you know, that date is going to be when this worst return happened. So I just need to actually look up the 931st number in column B. All right, because column B, excuse me, column A, because column A is actually for dates. Okay, so I'm going to do an index function here. All right, Excel says, you know, what is the, you know, reference here? Well, I want to look at the 931st number here. Oh, excuse me. I want Excel to look up the you know, data array, which is actually in column A. So that's A4, all right, column A2518. All right, Excel says, what is the index for the row you're trying to look at? Well, I want Excel to look up the 931st row. All right, so if I do that, Excel says that is September the 17th of 2002. All right, so now let's actually, you know, verify this manually. September the 17th of 2002, is that when the worst return happened? All right, so let's actually scroll down here. All right, you know, 2002, so we're still, you know, where is it? I should have probably used the scroll down here. 2002, September, we're almost there, okay, 930 something. So let's just look at, all right, September the 17th of 2002. All right, and yes, that is when the worst return happened. Okay, that's actually 934th row, but that's because we actually have, you know, 3 rows devoted for other things, you know, in column C. Okay, so that is actually, you know, working very, you know, nicely for us. Okay, if you want, you can actually, you know, embed these 2 functions together. So I'm going to actually do an index function here. I want to look up, you know, column A4 through A2518. I want to look up the 931st row, but that is actually coming out of the match function here. So that's negative 12.82 and C4, C2518. Okay, and I want to do exact match. And I'm embedding these 2 functions, and yes, that works very nicely. Okay, you know, if this is a little confusing, you can actually break this down into 2 steps. All right, so I'm going to leave this to you to look up, you know, when is the worst return here, and that's going to be, you know, July the 9th of 1999. All right, you can actually replicate this answer here. That's 1999, July the 9th. Okay. All right, so you can look up this number on your own. All right, number of 0 return days. So I can actually say, all right, you know, if the return is actually equal to 0, then you actually, you know, count. All right, so I'm going to look at all the returns in C4, C2518. All right, and you know, the criteria is, when do you count? Well, you count if the return is equal to 0. Okay, so would that work? Yes. So you have 43 days out of this 10-year, you know, period where, you know, McDonald's return is actually 0. Okay, the price does not change. All right, so that's a very simple, you know, illustration of, you know, some primitive analysis you can do based on this 10-year data on McDonald's. All right. So now the next thing is, I want to be able to actually plot a little, you know, a table. You know, plot a little graph. I want to actually look at, you know, something called a frequency distribution. All right, so how do we do that? So let me just erase everything here, and let me actually outline, you know, all the steps you can follow, so you know what is a frequency, you know, distribution, you know, graph, or the so-called histogram. So essentially, you know, out of these 2,500, you know, returns, you're trying to actually, you know, establish a few bins, okay, and it's like a few buckets, all right, and you know, each bucket is actually an interval, And if the return is actually, falling into its own interval, you start to actually count how many returns you have across each interval. Okay, and then you plot the height of, the number of days or number of returns, in each bucket. Okay, so if I want to do that, I would have to first of all, step number one, determine the number of buckets, or the so-called the number of beans. All right, so this actually is a little arbitrary, but if you want to have a nice looking frequency distribution graph, you might want to have maybe 30. All right, so I just want to throw 30 beans here, or 30 buckets here. All right, step number two. All right, once you determine you want to have 30 beans, all right, determine the bean size. In other words, how large is each interval? Okay, or I should say the size of each interval. All right, so I'm going to look at the worst return here. For McDonald, I have that. This is negative 12.82 or negative 13. And I can actually look at the best return here for McDonald here. This is actually about 10%. So I can actually look at the difference, which actually is a statistical concept called range. So I'm going to do the best minus the worst. So that is actually about 23.49%. So now I'm actually going to split this into 30 intervals. So how large is each interval? All right, so interval length or interval size. So I'm going to do this divided by 30. So that's about 7.749. So I'll take this to be 0.0075. Okay, so that's going to be the size of each interval, and I can actually format this as a percentage. So that's actually 0.75%. Okay, all right. Step number three, I'm going to build the list of intervals, or the so-called buckets. All right, so watch me closely. I'm going to start with the worst return, and I'm doing a little rounding here. So the worst return is negative 12.82. So let me have negative 13. All right, and now I'm going to do this by adding 0.75% each time. So that is going to be my first bucket. Okay, you already know that this first bucket should have at least one return. Why? Because the worst return is negative 12.82. So that is that should be there. All right, the bucket should at least have the day for September the 17th of 2002. All right, so this is our first interval. And now I can actually go, down here, and you just need to look at when you need to stop. Okay, so, can I stop right here? 2%? No, because the best return is actually, about 10%. So I want to, make sure I will include the best return in the list of buckets I'm going to have, or otherwise I'm actually having omissions for certain days. Okay. So, I mean, you can stop at 13.25, but that's not necessary because the best return is actually, 9.6 something. Okay, so you can stop right here. All right, so these are the list of, intervals. Okay, so I should say list of buckets. And now I'm actually going to do, frequency counts. Okay, so I'm going to look at, in this interval, how many days you're going to have, and so on and so forth. Okay, so here I'm going to actually introduce a very interesting and a very important Excel function called frequency. All right, so watch me closely. I'm going to actually highlight all these numbers here. Okay, so these are the cells I want to populate frequency counts with. All right. So in each of the cells, I want to populate the frequency count. All right, so what I'm going to do here is, after I select all these cells, I'm going to say this is equal to frequency. Okay, you can actually look at the explanation for this Excel function. This is saying it's going to calculate how often or how frequently values occur within a range of values and then return a vertical array of numbers. Okay, so that's basically the frequency counts. All right, so watch closely what I'm doing here. So Excel says you wanted me to do a frequency counts. All right, so give me the data. All right, the data is actually in the returns. So I know that's C4, C2518. And Excel says, all right, I know where the data is. Now tell me, where are the beans? Where are the intervals? All right, the intervals, well, we have built upon them already. So I'm just going to highlight all these, numbers. These are the list of intervals, one after another. All right, so close the parentheses. Now, this is the Excel array function, so you cannot press enter. You have to actually press Control, Shift, Enter at the same time. So I just did that, and you see that after I press the 3 keys at the same time, Excel populates all the number counts, automatically. All right. So look at this interval here. There's one, one day or one return that actually falls into this interval or this bin or this bucket. All right. And you can look at, for example, this one here. This is for the interval from negative 25 basis points to positive, 50 basis points. There are 533 returns, that actually fall into this bin. Okay, so this is really handy. And let me just, recap, about the Excel array function. All right, so frequency is an Excel array function. Okay, it's a very powerful Excel function. All right, so to execute any Excel array function, all right, not just for frequency. Later on, we're going to discuss something called matrix multiplication function. All right, so if you want to execute, you need to press, okay, Control and Shift and Enter at the same time. So this is a very demanding Excel function. It requires 2 hands from me. All right, my left hand, I press Control Shift, and my right hand, I press Enter. All right, so I don't know whether you can actually do this by one hand. All right, so this is the Excel array function, and now I can actually plot the frequency distribution, graph, okay, or the so-called histogram. All right, so can I do that? Well, I can actually highlight all these numbers here, and let's see whether this is going to work. All right, so these are the numbers I want to use in my chart, and I go to Insert, and I let Excel determine what is, you see that there are a bunch of, graphs Excel is recommending. So you can actually pick, pick the first one here, and yes, this would be, a very nice looking chart. I should say frequency counts, frequency distribution for CD, returns. Okay, 1998 to 2008. All right, so that would be a very intuitive chart name. All right, and my chart is actually a little jammed here, so I can actually move this chart title a little bit to the left. Okay, so this is a very simple illustration of the kind of things you can do based on the 10-year data for McDonald's. All right, so let me move on to example number 2, 3, and 4. Okay, so here we're now looking at 2 stocks at the same time. All right, so we have monthly observations in column A, and then we have HSBC, all right, Hong Kong Shanghai Banking Corporation, and then we also have China Mobile. All right, so if I want, I can actually calculate the holding period return here. So these are basically calculating the return based on the price. So watch closely. I'm doing the return for September, for the August of 2001 for HSBC. All right, so I'm doing the end of August the price, which is beginning of September price, minus, all right, the end, the beginning of August, the price, okay, divided by, the beginning of August, the price, okay. So that will get me the return for HSBC over the months of August 2001. All right, that's a very bad return. In this month, HSBC lost 16%. All right, so I can actually copy this down, and it's about 2% loss for China Mobile. And I can actually copy this down, and I can actually calculate all the monthly returns in our sample period. Okay. Now let's look at a few important statistics here, and this is trying to get ready for what we're going to do next. Okay. All right. So let's look at, first of all, what's the average return for HSBC. All right. So I'm going to look at the average return for HSBC over the sample period. So the first one is going to be E3. The last one is going to be, all right, let me scroll down here. The last one is going to be E63. Okay. So that is the average return for HSBC. And can I copy to the right? Well, I can actually calculate the average return for China Mobile. And you look at these two numbers and you say, all right, I like China Mobile because on average, China Mobile delivers much higher returns as compared to HSBC. What's the problem? All right, what's, if you have to comment on this, statement, what would you say? All right, well, remember, we're just looking at the return side. Okay, so China Mobile is logging better returns, on average, but what about the risk? All right, so you would have to calculate or look at the risk here. So if I want to look at the variance, all right, I can actually look at something called VAR. There are many VAR functions here in Excel. So I'm going to stay agnostic. I'm going to ignore the difference between all these VAR functions. All right, some of you will actually want to look at this, in your stats clause. All right, so I'm going to just go ahead and play with this VAR function here, E3, E63. Okay, so that is the monthly variance for HSBC. I can actually copy across, and yes, you see that China Mobile has better returns, but China Mobile is actually about 3 times riskier. Okay, I can also look at the standard deviation. So I can do the square root of the variance. Okay, that's one way. All right, so you can also copy this across, and that's getting the square root of the variance for both stocks. Or alternatively, you can do standard deviation and STDV. Make sure you spell the function name correctly. E3, E63. And would that produce the number? Yes. Again, I'm ignoring the difference between like a population standard deviation versus a sample standard deviation. All right. So if you're interested, you can look up your notes in your stats clause. All right. So, very simple risk and return, table here. All right. So I'm going to build the so-called variance covariance matrix between HSBC and China Mobile. Now, you may ask me, why do you want to build such a matrix? Okay, a matrix is basically a table of numbers. All right, or this is a table. This is a 2-row, 2-column table, and so we can actually refer to this as a 2-by-2 matrix. All right, so we have the first row, the second row, the first column, and the second column. So I have 2 stocks here. So the reason I want to build this 2-by-2 matrix is because there might be some portfolio manager who is actually focusing on these 2 stocks. Okay, so you can actually form infinite number of portfolios based on these 2 stocks. And you might want to actually look at, hey, what is the risk I'm taking if I invest in this manner versus in another alternative manner? All right, so that's why I want to talk about the variance covariance matrix. So here, watch me closely. I'm going to build the variance covariance matrix in the following manner. In the first row and the first column, this is for HSBC. I'm going to put down the variance here. Okay, and this is the second row, second column. You look at the second row, this is for China Mobile. The second column is for China Mobile as well. So I'm going to put down the variance for China Mobile. okay? And now I look at the first row and the second column. So this is the first row, second column. This is the second, second row, first column. All right. So these two are actually measuring something called covariance. The covariance is measuring the co-movement between, any two stocks. All right. So I can just use a CoVar function here. And again, you have the population versus the sample covariance, but I'm going to ignore that. All right. E3, E63, and F3, F63. Okay, if I do that, I calculate the covariance between these two stocks. All right, so the covariance number is actually positive, saying these two stocks, they tend to move in the same direction. All right, if it is negative, then these two stocks, they tend to move in the opposite direction. Okay, so I'm going to set that equal to this number here because the covariance or the co-movement between HSBC and the China Mobile, well, that's the same as the covariance between China Mobile and HSBC. So it doesn't matter, which one comes first when you look at the co-movement. All right, so that is the the variance covariance matrix, and we see that the first row, first column, second row, second column. This is the so-called diagonal line. All right, and the first row, second column, and the second row, first column. This is the so-called off-diagonal line. Okay, so more on this, in a second. All right, and I can also look at the correlation coefficient. So HSBC is perfectly positively correlated with itself. All right, so I have two ones here, and I can look at the correlation coefficient between China Mobile and HSBC, and you can actually look at something called a correl, and there's a correlation function here, or you can actually look up your stats note, and in that class you learned if you want to calculate the correlation coefficient between these two stocks, you can actually look at the covariance between these two divided by the product of the standard deviations. So I have the standard deviation for HSBC, I have the standard deviation for China Mobile. I can do it this way. All right, so that's about 57 or 58%. Okay, again, this correlation matrix is also symmetric. All right, if you use the correl function, you may actually get a slightly different number. All right, so that is the risk and return and the variance covariance matrix. Now, in your Finance 201, you may actually have gone through this step-by-step calculation here. So what I would do is actually very straightforward. I'll actually replicate this number here manually. All right. So if I want to actually perform this step-by-step calculation, what I need to do is actually first of all let me get the returns for HSBC. All right. So these are the returns, and I can actually copy these down here, and I get the returns for HSBC. This is basically copying column E here. And now I'm going to look at something called deviation. All right, so I want to look at what's the risk, what is the volatility in this HSBC return. And so I have to look at every day, how far does the HSBC return deviate from its average. Okay, so I'm going to look at HSBC return, and I'm going to subtract the average return from that. Okay, I want to lock down the average return because I want to do this for every single day in the sample period, or actually every single month. Okay, all right, so that is the the deviation. And if I just want to add up all these deviations, I have a problem because there are positive deviations and negative deviations, and they will cancel against each other. So I don't want to see that. Now, you can do different things to avoid the cancellation of positive ones against negative ones. But one thing you can do is actually you can square them. Okay, some of you will say, can I just take the absolute value of them? Of course. All right, but you have to taking the square root is more commonly used. All right, so I'm taking the square root of the deviation, and now I'm going to actually add up the sum of the squared deviations. So that's just going to be adding up all the numbers in column O. So that is O3, O63. Okay, So that will get me the number, which is the sum of the squared deviations. And now, if I just want to get the variance, I would divide this by the total number of deviations minus 1. Okay, so I'm just going to do a count function here, 0.3, 0.63, and then do minus 1. So you may ask me, why do you do minus 1? Well, you do minus 1 because there is the so-called degree of freedom adjustment. You have used all the returns to calculate the average return. So you lost 1 degree of freedom. All right, so the standard deviation is nothing but the square root of the variance. So you see that these two numbers, they actually replicate, these two numbers here for HSBC. Okay, as you can see, you don't have to do this, step-by-step calculation because you have the standard deviation function or you have the variance function. But I want to discuss them because you can still actually get some intuition as to why it makes sense for you to actually look at the deviation, square them, and adding them up, and dividing that by the total number of deviations minus 1. Okay? All right, so let me move on to example number 5. This is also looking at, the correlation and the covariance between Kellogg and ExxonMobil. All right, so we have the annual observations here. These are the annual returns. So if you want, you can actually look at the average. All right, so the annual return for Kellogg is about 6%. I would say that seems to be lackluster because of the time period you're looking at. All right, so you have the 2007 to 2009 financial crisis, and you have the dot-com bubble, burst period, and no wonder the returns here in this period is actually not so great. And you look at the ExxonMobil, that average return is about 11.71. Okay, you can also look at the variance, and here I somehow used the population variance. Okay, that may not be appropriate because this is only a sample. All right, and if I want to change this to VAR, the number will change slightly. All right, and then you can look at the square root of the variance and you get the standard deviation, and you can look at the covariance, and that's what we did. And you can look at the correlation coefficient. So if you do the correl function, you get 34.82. But if you actually do by or go by the formula, you get actually 31.33. All right, so there is a slight difference between the results from these functions, and that's actually caused by the treatment of this data as the population or as a sample. Okay. All right, so these examples so far are actually for realized returns. So if you have collected the data, you can actually calculate the returns. You can actually look at the risk and the return. And you can also look at the co-movement or the covariance and the correlation structure between any two stocks. All right, so now let's move on to expected returns. So now instead of looking backward, we're going to look forward. We're going to look at what's your expectation about the returns on different stocks. Okay, so imagine as a security analyst, you're trying to forecast the target price for a company you're covering. And so to some extent, you're actually, form your expectation about the returns over, let's say, the next year. All right, so the way we actually, form our expectation is very straightforward. I'm sure you guys have done this in your Finance 201. All right, so we slice the uncertainty of the future into different states of economy. So in this case, we actually sliced the uncertainty of the future into 4 states of economy: depression, recession, normal, and boom. And then we assign probability to each state of economy. All right, so in this case, this might be from a very pessimistic analyst, and he or she is actually assigning 40% of probability to depression, and 30% to recession, and 20% to normal, and 10% to boom. Okay, I don't like this probability assignment at all. All right, it's too pessimistic. Okay, but it can still illustrate what we need to do. All right, so I'm looking at the returns, for stock A under each state of economy, the returns for B under each state of economy. So how do I form expectation? Well, if you want to form your expectation for the expected return on stock A, you just look at each state of economy, all right, and then you apply the probability as the weights. So I'm looking at return for A under depression, and that happens with a 40% of probability. And I'm looking at the return for A under recession, that happens with a probability of 30%. And the return for A under normal, that happens, with that's 30% of return, and that happens with a 20% of probability. And the return for A under economic boom, that return is 50%, and it happens with a 10% of probability. So you do the calculation, that's 6%. And you look at this formula here, it's a little tedious, and you have to click 8 different cells. All right, so if you don't want to do that, you can actually use some kind of sum product function. This actually is a very interesting Excel function because let me show you what this can do. All right, so this function actually has 2 steps here. First of all, is going to do the multiplication, and the secondly is going to actually add up all the results after the multiplication. So let me take all the probabilities. Let me take all the returns. Okay, so if you do that, and if you press enter, Excel is going to produce 6% as well. And that is much faster. But of course, you would have to line up the returns and the probabilities, very nicely. All right, before you can actually, apply this sum product function here. Okay, so you can actually, look at the expected return for stock B. I'm doing a sum product function here as well. So that's actually 6.5%. All right. So now the next question is, what is the standard deviation for the expected return on A versus B? And also, what's the covariance between A and B expected returns? All right. So if I want to get the variance for A, I just need to look at a similar methodology. I would have to look at, first of all, what's the deviation for A under each state of economy? All right, so A returns negative 20% when there is depression, and on average, the expected return is 6%. So that's the deviation for recession, for depression. All right, so that's negative 26% because on average, A expects to return 6%, and yet when there is depression, A returns negative 20%. So I can copy this down here. I get the deviation for A, and you can do the same thing for deviation for B, and then you take the square deviations. All right, so you take the deviation and you square them, so you have all these numbers here, and the same for the square deviations. All right, and then you can actually take the product of the deviations, which is nothing but the deviation for A times the deviation for B. All right, and you may ask me, why are you doing this? Well, we're going to use that for the covariance calculation. All right, so I'm going to look at the variance for A, and this is the probability weighted averages of the squared deviations. So I'm going to do the sum product function here again. I'm looking at the probability, I'm using them as the weights, and I'm looking at the squared deviations for A, and that will get me the variance for A. All right, so that's about 5.84%. Okay, and you can also look at the variance for B, which is actually very similar. You're taking the squared deviations and you're applying the probability for each state of economy as the weights. All right, so that will get you 0.12465. And now I just want to do the covariance. So I want to actually take the probability weighted averages of the product of deviations. So I'm taking the product of the deviations and I'm applying the probability and I can also get my correlation based on the covariance. So correlation is defined as the covariance divided by the product of the standard deviations. So I would do the square root of the variance for A, right, times the square root of the variance for B, and of course close the square root, close the denominator. All right, so that's actually negative 17%. Okay, so very simple illustration of calculating the expected return and the variance for individual stocks as well as the covariance. All right, so now let's move on to a bit more complicated example, because now we're going to look at the expected return and the variance of the expected return on portfolios. Okay, I don't like this gray color here, so let me just format this into green here. Okay. All right, so now we're looking away from individual stocks. We're moving into portfolios. All right. So let's just look at this example here. This is example number 7. All right. So given the following information, what's the variance of the returns on a portfolio that's invested 40% in A and B and 20% in C? All right. So these are the inputs. Okay. So just to make our lives a little simpler, we have only 2 states of economy here. All right. We have normal and we have recession. All right. And we have the probability assignment. Okay, for A, for normal, that happens 87% of the time. For recession, that happens 13% of the time. All right, and you have returns for 3 stocks, A, B, C. All right, so for A, that's 13.40, 2.10. For normal versus recession, and the other numbers here as well. And they have the portfolio weight. That's 40, 40, and 20. All right, so if you have $1. As your portfolio, then you're going to invest the 40 cents in A. However many shares you can get, you just spend 40 cents in A. All right, and the 40 cents in B, and the 20 cents in C. Okay, so the question is, what is the variance? Well, first of all, can we calculate expected return of the portfolio? All right, if I want to calculate expected return of the portfolio, I can actually do that in a very simple way. All right, so one thing you learn from your Finance 201 is you can actually get your expected return for ABC. All right, so I should say expected return for A, and I'm going to get this for B and C as well. All right, so let me just change this to B and change this to C. Okay, all right, so I have expected return for, oops, I should actually start here. All right, so expected return for A, that's the sum product of the probability as the weights. And I want to be able to copy across, so I need to lock down those probabilities. And I have the returns for A under each state of economy. So that will get me the expected return for A. And I can copy this across. Okay, so these are the expected returns for the 3 stocks in this manner. And now I can actually say, hey, what's the expected return on my portfolio if I invest in this manner? All right, so I'm going to do another sum product function here because I have the portfolio weights here and I have the expected returns here. So yes, I can actually get my portfolio expected return. That's actually 11.32%. Okay, so that is fairly straightforward. All right. Now, if you don't want to do it this way, alternatively, you can actually look at your portfolio. Okay. So I'm going to look at my portfolio, and I'm going to look at my portfolio return when the economy is normal. All right. So I'm going to look at the probability. The portfolio weights on the 3 stocks and the return on 3 stocks when the economy is normal. All right, so that is saying if the economy is normal, my portfolio is going to return 14.26%. Now, what if the economy is actually in a recession? Then I'm going to do the same thing. These are the portfolio weights, and these are the returns under 3 stocks for recession. All right, so that's going to be negative 8.28%. So now I can actually look at, hey, what's my expected return for my portfolio? So I can do the sum product of the probability as the, probability assignment as the weights and the return under 2 state of economy. So in this way, I'm essentially treating my portfolio as another stock. Okay, yes, that replicates the portfolio expected return. So it's up to you. All right, if you want to calculate portfolio expected return, you can take both approaches. Okay, all right, and the question is, what is the variance? How do we go about the variance for this expected, for the expected return on a portfolio? All right, so I'm going to actually focus on the second method here, and I'm going to show you how we're going to actually do a matrix multiplication to produce this variance for a portfolio. Okay, and I do have a separate video to explain the the mechanics of matrix multiplication. All right, so if you are confused after today's lecture, you can actually look up, watch that separate video. That's going to clear up a lot of confusion you may have. All right, so I have my recipes here. Okay, so the 4 steps. Step number 1, let's calculate a bunch of variance and covariances. And why do we need that? Well, because we need to build the variance covariance matrix, and that's what we have here. All right, so I'm going to skip all the step 1 here because we have done this already in example number 6. So it would be a very good exercise for you to replicate all the numbers. So first of all, let's just look at the variance for A. All right, so remember, this is a variance covariance matrix. Okay, just let me elaborate this here one more time. All right, at the risk of belaboring the obvious. Okay, so you want to put down the variance for A here, and you want to put down the variance for B here, and you want to put down the variance for C here. Okay, whoops, I think Excel doesn't like the equal sign. All right, so that is the diagonal line. All right, variance for A, B, C, because this is the first row, first column, second row, second column, third row, third column. So these are actually for the variance terms. These are the so-called diagonal line. And this is covariance between A and B. All right, well, that's because you're looking at the first row, second column. So this is a 3x3 matrix. And this is the covariance between A and C. All right, so that is the first row, third column, okay? And this one here, well, it's actually symmetric, so this one is actually equal to that one. All right, and this one here, well, this one is actually equal to that one, okay? So if I press enter, Excel doesn't like that, so I get around this by doing this little thing here, all right? And this is the covariance between B and C, okay? And again, this is symmetric, so this is going to be equal to this number here. All right, so that is the variance covariance matrix, and this is a 3x3 matrix because you're looking at a 3-asset portfolio. All right, so where does the variance for A come from? It's coming from this number here, okay? The sum product of the probability and the square deviations for A under each state of economy. All right, this is the variance for B. Okay, same deal, except you're looking at different numbers. And this is the variance for C, all right, same deal. Now let's look at what's the covariance between A and B. So this is the sum product of the probabilities for each state of economy and the product of the deviations between A and B under each state of economy. Excuse me. All right, so same here. Once I have this, I can actually say, all right, watch me closely. I can actually use a transpose function here, okay? So remember, transpose function is an Excel array function, all right? So the execution requires Control, Shift, Enter. What it does is it's going to transpose this one row into one column, all right? So let me do the transpose function here, and I'm going to take these two numbers at the same time, close the transpose, Control, Shift, Enter. All right, and yes, that's going to be taking this number. And some of you will say, can I transpose this cell here? Yes, but it's a scalar, so there's no need. All right, you can just say this is equal to that. Okay, all right, so that's the variance covariance matrix. So now, I need to actually, finish the sandwich formula. All right, so to calculate the portfolio variance, need to build a sandwich formula. All right, so what is the sandwich formula? The sandwich formula, you guys know how to make a sandwich. All right, you have the bread, and then you have the meat, and then you have the bread again. All right, so the bread, the meat is actually sandwiched by the bread. All right, so here we're going to have the portfolio weight matrix on the left multiplied by the variance covariance matrix. Okay, multiplied by the portfolio weight matrix again. All right. And actually, to be rigorous, this should be transposed. Okay, and I'm talking about a matrix multiplication here. So dimension check is extremely important. All right. So in this case, the way I set up my question, my portfolio, weight matrix, that's one row. That's one row, 3 columns. So the dimension here is 1 by 3. Okay, and the variance covariance matrix, that's a 3 by 3 because it has 3 rows and 3 columns. And the portfolio weight matrix on the right, that's if I want to make sure the matrix multiplication work, I need to have all right, I'll leave that for us to understand in a second. Okay, so the way you do the matrix multiplication is to make sure the number of columns for the matrix on the left is the same as the number of rows for the matrix on the right, so that you can actually do the matrix multiplication. All right, so I'm doing this, portfolio weight matrix times the variance covariance matrix. Portfolio weight matrix times the variance covariance matrix. Okay, so this is my step number 1. All right, so portfolio weight matrix, that dimension is 1 by 3. Okay, and the variance covariance matrix, that dimension is a 3 by 1. Right, excuse me, 3 by 3. Okay, so the resulting matrix, all right, listen up. Okay, so the resulting matrix, it's going to be having the same number of rows as the matrix on the left, which means it's going to have a 1 here, and it's going to have the same number of columns as the number of columns for the matrix on the right, which is actually going to be 3 here. In other words, if you want to think of this, these 3 here, all right, these 3 here, and these 3 here, they cancel. Okay, so that's one way of understanding the matrix multiplication. So the 3 and the 3, they cancel, so you're left with a 1 by 3. All right, so I know the resulting matrix is 1 row, 3 columns. So I'm going to do the matrix multiplication now. All right, so mmult stands for matrix multiplication. This is a very powerful Excel function. It's an array function. Okay, so I'm going to do the portfolio weight matrix, that's 1 by 3, and I have the variance covariance matrix, that's a 3 by 3, close the matrix multiplication, and remember this is the Excel array function, so Control Shift Enter. All right, so that's a step number 1. I have the portfolio weight matrix times the variance covariance matrix, and I get a 1 by 3 matrix. Step number 2, to multiply the resulting matrix in the first step by the portfolio weight matrix on the right, and this time I need to transpose that. Why? Because let's look at the resulting matrix in step number 1. All right, the resulting matrix is 1 by 3. Okay, so in order for this matrix multiplication to work, I have to have a 3 here, and I have to have a 3 by 1 because, as I said, the 3 and the 3, they cancel, so you're left with a 1 by 1, which is a naive matrix, which actually is a scalar, it's a number. Okay, so that's why I need to actually have a 3 by 1 portfolio weight matrix transposed. Okay, so because the portfolio weight matrix is a 1 row, 3 column. And if I transpose, I just switch the row and the column. So I have a 3 row, 1 column. All right, so now I can actually do the matrix multiplication here again. This time I know the resulting matrix is just going to be a number, so I can just use 1 cell. All right, matrix multiplication of the resulting matrix in the first step, and I need to transpose the portfolio weight matrix here. All right, that's because I set up my portfolio weight matrix in a row. Okay, close the transpose, close the matrix multiplication, and press Control Shift Enter. And I just run into a problem here. What is that? Matrix multiplication. Oh, I have extra parentheses here. Okay, all right, Control Shift Enter, and yes, that's going to be our portfolio variance. Okay, so now you can actually combine these two steps. Okay, you can actually do something that is really fancy, but you have seen, you will actually see the sandwich structure very clearly. All right, so I'm going to do a matrix multiplication. I'm going to do another matrix multiplication, and I'm going to do the portfolio weight matrix here, and then I'm going to have the variance covariance matrix here, and I need to close the inside matrix multiplication with a comma, and I'm going to transpose the portfolio weight matrix here again. All right, so that's the portfolio weight matrix here. Close the transpose, close the outside matrix multiplication, press Control Shift Enter, and yes, you replicate the portfolio variance. But the beauty of this high-tech formula is that you clearly see a sandwich structure here. This is the portfolio weight matrix on the left. This is the variance coverage matrix in the middle. And this is the portfolio weight matrix on the right, except it's transposed. It needs to be transposed because we need to satisfy the conformity condition for matrix multiplication. All right, so please watch the separate video on matrix on using matrix multiplication to calculate portfolio variance. Okay, I do have a separate video, and that actually has a lot more details in it. All right, so that's example number 7. All right, the video is out, is now 1 hour and 6 minutes. So I think I can just finish, example number, 8 here. I'll, finish the rest of the, examples, in the model portfolio theory chapter. Okay. All right, so this is our final example, and this is the culminating example of this risk and return chapter. Okay, and let's see how we can actually get this done. All right, so now we have a lot of very powerful tools at our discretion to actually calculate some kind of portfolio related probabilities. Okay, you may ask me, why do you want to do that? Why do you want to calculate portfolio-related probabilities? Well, because as a portfolio manager, you're really concerned about, for instance, the potential downside. All right? And you want to look at, for instance, the worst case scenario. What's the probability that my portfolio is going to be worth less than, let's say, $20 million? Okay? I'm looking at what about the upside? Well, if there's upside, I'm not that much concerned. I'm concerned about the downside. Okay, so that is the argument or the motivation. Okay, so suppose you have $40,000 you would like to invest equally in 4 securities A, B, C, D. The expected returns from the securities are 10, 11, 12, and 13% respectively. And we have the expected returns. Okay, that's one side of the coin. And the standard deviation of the returns are 12, 14, 16, and 18. So that's the standard deviation of these 4 stocks, respectively. And the correlation coefficient between any two is 0.8. So between A and a B, that's 0.8. Between A and a C, B and a C, C and a D, A and a D, however many combinations you have, that's just going to be 0.8. So really, this is greatly simplifying our job. All right, if the returns are normally distributed, what is the probability that the portfolio is going to be worth more than $50,000 after 1 year? Okay, so now we're talking about normal distribution. Okay, so normal distribution, all right, for a random variable. So we know that if the portfolio return follows a normal distribution, all right, so you would have to get the mean and the standard deviation. All right, if you know the mean and standard deviation, by the way, this is the way math people actually denote this. All right, so this tilde sign is indicating the returns follow a normal distribution. So we just need to find out the mean and the standard deviation, and then we can actually calculate the probability, a portfolio related probabilities. Okay, so what should we do here now? All right, first of all, you're investing equally, so the weights are going to be 25% for each of these 4. All right, it's a quarter. All right, so if you have 500 assets in your portfolio. Let's say you're trying to mimic S&P 500 index return. Well, you're trying to have 500 portfolio stocks in your portfolio. Okay, so the portfolio, if you're doing equal weighting, well, each portfolio is going to each asset is going to get a weight of 1/500. All right, so in this case, it's 1/4. If that's the case, what is the portfolio expected return? Well, that's so easy. All right, so we know how to calculate portfolio expected return. It's nothing but the portfolio weighted averages of the expected returns of the individual stocks in your portfolio. So I'm doing a sum product of the portfolio weights and expected returns. All right, so that's 11.50%. So I know the mean for the distribution, that's 11.50. Okay, on average, my portfolio is going to return 11.50. But there can be good years, the return is actually much better than that. There can be bad years, the return could be much worse than that. On average, it's going to return 11.50. Okay, so if you want to look at on average how much you're going to have in in 1 year, you start with 40,000 and you're going to earn 11.50 on average. So you're going to end up with $44,600 in 1 year. Okay, all right, so now the question is, what's the standard deviation? Okay, so you need to calculate the portfolio standard deviation in order for you to calculate the portfolio portfolio return related to probabilities. Okay, so by the way, this capital R is the portfolio percentage return. Okay, I'll get to that in a second. All right, so now if I want to calculate the portfolio variance or portfolio standard deviation, all right, I need to actually go by use the variance covariance matrix approach. All right, so I have built this variance covariance matrix here. Okay, let's just look at this here for a second. This is the variance for A, so that's going to be the standard deviation for A squared, and this is the variance for B, the standard deviation for B squared, the variance for C, standard deviation for C squared, and the variance for D, standard deviation for D squared. Okay, now this should be the covariance between A and B. Now I know the covariance between A and B is the correlation coefficient, which is 0.8 times the standard deviation for A times the standard deviation for B. Now, if I want to be a little greedy, if I want to be able to copy across, I need to lock down the B11, which is the standard deviation for A here. All right, so if I lock down, if I copy this across, I get my first row here. Okay, and I know that this is going to be equal to, so this is a symmetric matrix. So I'm going to do a transpose here. All right, I'm taking these three, numbers in a row and transpose that into three numbers in a column. Okay, Control, Shift, Enter. All right, so that's good. All right, so I get these numbers here. So imagine these numbers are not filled in yet. Okay, all right, so I just, start from scratch. All right, so now let's look at, this is the covariance between B and C. So that's 0.8 times standard deviation for B, lock this down, times standard deviation for C, and that will do it. All right, so I can copy this across, and I get the covariance between B and a D here. So let me just double check. All right, B and a D. So the standard deviation for B times the standard deviation for D times the 80% correlation coefficient. All right, so that's good. So I can copy these down here by doing this transpose function here again. So this is the transpose and Control Shift Enter. All right. So now I have one more covariance to go. That's the covariance between C and a D. So that's 0.8 times standard deviation for C times standard deviation for D. Now there's no need for you to lock down anything because you're not copying down or copying across. Okay. So I can actually get this here. This is a symmetric matrix. In other words, the i's row, j's column is the same as the j's row, i's column. All right, if I want to talk a little bit more about matrix algebra. All right, so that's the variance covariance matrix. Okay, and now, the sandwich formula. All right, so remember, you're always having the matrix multiplication here and matrix multiplication here. So let's make a sandwich. All right, so that's the portfolio weight matrix. That's 1 by 4. So it's multiplied by a 4 by 4 here. Okay, and 1 by 4 times the 4 by 4, you get a 1 by 4. Now you need to have a 4 by 1. So I'm going to transpose the 1 by 4 portfolio weight matrix into a 4 by 1. All right, close the transpose, close the matrix multiplication, Control Shift Enter, and yes, 0.01915. That's the portfolio variance. So now I can actually say, hey, portfolio standard deviation, that's going to be the square root of the variance. All right. So that's going to be 84%. Okay. All right. So that is the parameters for this normal distribution. All right. So now if I want to calculate what's the probability that your dollar portfolio is greater than $50,000. Okay. So this is essentially saying your percentage of return is greater than what? All right. Well, you start with 40,000, and you want to have 50,000. So the percentage of return is 50,000 and minus 40,000. That's 10,000 over 40,000. That's 25%. Okay. So you want to calculate this probability. All right. And from our probability knowledge, we know this is equal to 1 minus the probability that the percentage of return is less than 25%. Okay, so the probability that the percentage of return is less than 25%, this is equal to the normal cumulative distribution function evaluated at 25%. Okay, so we're talking about a CDF here, which stands for the cumulative distribution function. All right, so I want to actually evaluate this probability now. So this is equal to norm dist. All right, okay, so this is equal to norm dist. This is actually normal distribution, and I'm looking at the value I want to evaluate at, which is 25%, and the mean is 11.50. The standard deviation is 13.84, and Excel says, is this a CDF or is this a PDF? All right, so I want to say this is a CDF. It's the cumulative distribution function. Okay, so that is 83.54%. So the answer, the final answer, that's going to be equal to 1 minus the probability, and that's going to be 16.46%. Okay, so this is the final answer. This is the probability that your portfolio is going to be worth more than $50,000 in 1 year. In the way, according to the way you invest in these 4 stocks, according to the way these 4 stocks behave. All right, you have the expected return, standard deviation, and so on and so forth. Okay, so you see that this is a fairly challenging example, but we're able to eventually calculate the answer based on the normal distribution properties, as well as the portfolio standard deviation or portfolio variance calculation using the sandwich formula. All right, and you can actually combine these 2 steps here. So I'm going to drive some of you crazy by doing this square root of the matrix multiplication again, and I'm taking a 1 by 4 and I'm doing a 4 by 4. And then close the inside matrix multiplication and do the transpose of the portfolio weight, and close the transpose, close the outside matrix multiplication, close the square root, Control Shift Enter. Okay, so this is really a high-tech formula, and you can still work out this standard deviation using this high-tech formula. All right, so this video is now an hour and 20 minutes. I think it's getting too long, so I'm going to stop right here. All right.